Are you wondering how life insurance works, or how does indexing work inside of a life insurance policy? In this video, I'm going to explain what is a stock market index, the difference between index funds versus stocks, and then what is Index Universal Life Insurance, or an IUL, and how does indexing really work. I'll give you examples of how a policy performs when the index increases, as well as how the policy performs when the index decreases. You'll see how to earn money inside of your policy and that it grows, yet never have any losses. The end result is that you have a fabulous way to actually create and grow your money and your wealth and actually create a tax-free retirement or income streams. Sounds great? Let's get started. My name is Gail Longenecker. I've consulted to hundreds of entrepreneurs, executives, and engineers in the area of life insurance. For the best life insurance advice, subscribe to my YouTube channel below and hit that bell to be notified when I upload new videos. So first, what is the stock market index? There are many stock market indexes in the US, like the S&P 500, Dow Jones, or the NASDAQ. Those are probably pretty familiar to you. It is a calculation of the average of a specific set of stocks. Each index has its own set of stocks that it averages. For example, the S&P 500 looks at the stocks of the 500 largest companies in the US as determined by Standard & Poor's, S&P. The S&P 500 is the calculated average of all those top 500 stocks. It's a way to quickly see how that set of stocks is performing. The Dow Jones Industrial Average is the average stocks of the top 30 largest companies in the US, and the NASDAQ, which is an average of the top 3,000 companies' stocks, is normally just looking at the technology sector. There are many, many more indexes in the US and across the world as well. If you have $10,000, you cannot buy a stock index because it's just a calculation. To invest in an index, however, you would actually have to buy a stock index fund from Vanguard or Fidelity or from your financial planner, for example. This is the difference, index funds versus stocks. If you were to put away your money into a stock index fund with one of these companies, you would see your money grow and earn money when that underlying index increases. You would also see your money lose money or decrease when that underlying index decreases. An IUL redesigns the index fund idea. It's a life insurance policy, not a fund, that uses an underlying index to grow cash in the policy. So how does indexing work, and what is Index Universal Life Insurance? Let's review the basics of an IUL first. When you purchase an IUL, you are purchasing a permanent life insurance policy. This means that you'll have death benefit all the way to the day that you die, as long as your policy is in force. When you make a premium payment into your policy for your life insurance, a little bit goes toward providing the death benefit, the living benefits, and the fees on the policy. And then you have the powerful option to actually overfund the policy. The overfunded portion goes into a cash account. The amount that you're allowed to actually overfund into your cash account is determined by the government. We design your policies with the maximum cash allowed and the least amount of fees so that you actually have a lot of money working for you. When you take out money from that cash account, we do it in such a way that you pay actually no taxes on that money. This is how we can design tax-free streams of income, tax-free retirement, and insulate you from increasing tax rates. The power of an IUL is that this cash account that earns money is called credits, kind of like interest at your bank. And those credits are applied when the index increases. The unique protection of an IUL is that the cash account doesn't lose a dime when the index declines. So how does indexing work again? Well, let's see it in action when the index is increasing. When you set up your policy, you actually choose which indexes you want the cash account to look at. The insurance company doesn't use your cash to buy stocks, bonds, or mutual funds. It's technically only buying options against an index. When that index increases, they exercise the option for you, and the gain is credited back to your cash account. If the index decreases, they do not exercise the options, and therefore you do not lose a penny. It's genius, really. This is why that we say your money is not directly invested in the stock market. Rather, it's just looking at the stock market. When you set up your policy, besides choosing the index to use, you will also choose a multiplier for your policy. There's a little cost to use a multiplier, but its name is exactly what it does. It multiplies your gain. If you earn 10% with a 1.5 multiplier, you would earn 15% in your cash account. You also choose a time horizon, such as a 1 year, 1 month, 2 year, or 5 year point to point. This describes when the index will be measured in 1 year, 1 month, 2 or 5 years. If you choose the S&P 500, for example, annual point to point, then the index is measured today and in 1 year. If the index is at 1,000 today and 1,100 in 1 year, you've got a 10% gain. I need to also mention that there are caps or maximums that tag along with each index that the insurance company offers. The S&P 500 annual point-to-point might have a cap of, say, 12% or so, which means if the index grows by 19% that year, you would be capped at 12%. The multipliers applied after the caps. So in my example, if the index grew by 19%, you were given a cap of 12 times 1.5 is the multiplier, you get 18%. This is how indexing works. You choose an index, a timeline, and a multiplier. When the index increases, you can participate in the growth up to a cap. Starting to feel convinced that an IUL could be a really good idea? Leave a comment in the section below and let me know what's most exciting for you. What's your main reason that you would have to actually make a leap into purchasing an IUL for yourself? Also, since purchasing life insurance can be pretty intimidating, I've got many videos and resources for you on this channel. Be sure to check out what is an IUL, for example, to get all the details. So how does indexing work when the index is decreasing? The best example I can give you is the period from 1999 to 2010, where there are a lot of decreases with the S&P 500. Let's say you had $100,000 in 1999. How would your money performed in the market versus an IUL policy? From 1999 to 2000, or the first year, the S&P 500 increased by 10%. So both options gained 10% on your money. So you have $110,000 in either option. In year 2, the market fell by 9%. So your market account lost 9%, but your IUL had a 0% floor, so it lost nothing. In year 3, another 10% decrease. So your market account lost, but your IUL remained steady. Year 4, there was a devastating 24% decrease. So your market account is at an all-time low. Your IUL is still sitting pretty though with that 0% floor, and you're still holding on to the $110,000. In year 5, the index increased by a whopping 36%. Your market account is almost back to where it started at $100,000. Your IUL just added another 15%, which is the cap that particular year. So it's $110,000 plus 15%. This keeps going on for year 6, 7, 8, 9, 10, 11. The final answer is that your market account's final balance is only $82,000, while your IUL is $182,000. This is how the indexing strategy works. When the index increases, you can participate in its growth up to a cap. When it's decreasing, however, you are protected and you don't lose any ground at all. Often, in fact, you come out ahead from most other traditional market-based investments. If you'd like to see for yourself how life insurance works to give you peace of mind, then click on the link below to become my client. Also, if you like this video, give it a thumbs up, subscribe to my channel, and make sure you share it with a friend. Thanks for watching. And remember, I'm in your corner, helping you to build wealth your way.